And hopefully you guys can hear me. If not, I totally apologize on this. Once again, David Moore, Equity Advantage. We've got an hour of reverse exchange information. It's, as I said earlier, it's still a crazy market. We're doing lots of deals, lots of complex transactions, and things are moving along. So I guess we're finally up. I apologize for the delay. I owe you guys a few minutes of your valuable time, and I'll try to make good use of what's there. So once again, I apologize for the delay, and hopefully our technical difficulties are all taken care of. So reverses, you know, everybody's, it's 100 years old right now, been here a long time, still a lot of misinformation out there. Biggest problem we're having is everybody's moving so quickly these days. They're not really anticipating what's going on and getting things set up prior to closing. A reverse exchange requires the exchange to be structured prior to the purchase happening. If you close on something and then later want to do it, it's too late. So if we're looking at a delayed exchange, you're selling first, buying later. Reverse exchange, you're buying first, selling later. Either way, you cannot legally own the new property and the old property simultaneously. So the exchange has got to be structured prior to close of anything. So, you know, on the bright side, a lot of states have in their purchase sale, you know, the brokers have in their boilerplate language in the purchase sale agreements, they include some type of cooperation provision talking about an exchange. But a lot of times it simply states that you have the right or the option to do it, but nobody lets escrow know that it's going to be an exchange. So I would encourage you, when my brother and I started the company, you know, in 1991, we had pages of cooperation provisions we would get out to people, and it can be something as simple as, you know, buyer or seller agrees to cooperate with buyer or seller's 1031 exchange at no additional, you know, cost, liability, obligation, something along those lines. It's going to take care of it. But even if your state form has a provision in it, I'd encourage you to put something else there so that you ensure the deal gets done. Otherwise, you could be sitting there owning the new property in a reverse context before you've sold the old one, have ownership of both, and you no longer have the ability to exchange into it. And once again, on a typical delayed exchange, just your ability to touch the money, actual or constructive receipt of the funds, triggers tax consequences. So you cannot get this thing done retroactively. The exchange has to be structured before anything happens. So we've got a lot of good information. We're going to spend the first few minutes talking about 1031 basics, and then we're going to get into warehouse transactions primarily, like we're talking about reverses primarily today. We'll talk a little bit about partnership interest issues, because that is probably the second biggest problem we've got in the 1031 world, second only to time, is vesting. We will also talk briefly about notes in an exchange, because in this climate, we're starting to see more seller carrybacks for a variety of reasons. And contrary to popular belief, it is possible to do an exchange carrying paper. It's just a little more complicated. So if you're interested in watching this again later, it will be up on our YouTube channel. There's actually a 12-minute video on reverses. It does a pretty good job going over the basic nuts and bolts. But this thing will be up there, and it will span in excess of an hour. And hopefully you're going to get some good information out of it today. I like to say the little nuggets of knowledge. You know, don't feel like you've got to understand everything there is to understand about this stuff. Know what you need to know to get things set up, get things sort of organized, and understand you've got good resource to get the answers to those questions that you may have. So we all sit here and we watch TV shows. I try not to watch them real time these days, but when I do, I see ads for gold and silver and palladium and precious metals. And what are those metal brokers? What are they selling? They're selling tangible assets. I'd say real estate's the ultimate tangible asset. What's really interesting to me is, if you look at in the financial world, the investment world, real estate, basically all tangible assets are considered alternative investments, which is sort of crazy, because I think alternative makes it sound sort of flimsy and not that stable, right? But in recessionary times, yes, I said it, I had said the R word, in recessionary times, there's always a flight to quality, there's a flight to hard assets, and I would say real estate's the ultimate hard asset. Anybody on webinar that's owned precious metals, you understand that what that quoted price is and what you actually get for it when you go to sell it are two totally different things. But and you're still betting that that stuff's going to go up in value. Where real estate, I was taught never to bank on appreciation. I was blessed to have a great mentor when I got into this business, a guy named Ron Stash. And Ron, if you're out there, thank you. Spent lots of time in his minivan rolling back and forth up the interstates, learning about real estate, learning about exchanging, all kinds of different stuff. But he taught me never bank on appreciation. With real estate, you don't have to. Bottom line, at the end of the day, you hold on to it. I've got another buddy, Robert Nelson, that unfortunately we lost this last year, but he says, hey, real estate's not a get rich quick scheme, it's a get rich slowly but surely scheme, and he has one golden rule, and that is do not sell the property during a recession. I would say, once again, we're talking September of 22. Our volume right now is still crazy. It's still going very, very quickly. We've got lots of transactions happening. People are, I think, trying to get where they want to go. And so we're still very busy with respect to this stuff. So when we look at real estate, tangible assets, inflationary hedge, they're always a flight to quality. You got cash flow, whether it goes up or down, you're going to have some income, hopefully, if it's an income property. You got leverage that's possible out there. You can leverage a Wall Street account through your margin accounts. I guess it's probably the easiest way to do that. But typically, that's not something you're going to be using in that side of the investment world, where leverage is just commonplace in real estate. And when you're younger, it can be your best friend. As you get older, you're probably not going to like as much leverage. So when I got started in this business, the older people, the people with gray hair or less hair on this call probably remember a guy, Robert Allen, Nothing Down books, and that was a good entertaining deal when I got into this space. As I'm older, I probably want less leverage and more equity in things, and I'm just more comfortable that way. Interest deductions. Well, you've got interest deductions that are still there on this stuff. You've got depreciation that you're going to take. You've got somebody else paying down your mortgage. You got that appreciation at the end of the day. And then the best thing about real estate, if we're talking about pulling money out of your pocket to go buy it, we've got the 1031 exchange at the end of the day. So you can kick that tax liability down the road. Now, a lot of Wall Street money's IRA 401k funds, and a lot of people don't really understand, or maybe they've heard a little bit about, but you can take your IRA and certain 401k plans and go buy real estate also. And it's just further diversification. If you talk to somebody, just a regular financial advisor, they can say, okay, go buy a REIT, a real estate investment trust. Well, that's a stock. It doesn't give you the benefits and burdens of ownership. If you want institutional ownership of real estate, something passive where you don't want to have to deal with it, you can always look at Delaware statutory trusts, DSTs, or institutional tenancy and common properties. The difference between those two typically is DSTs are more like a REIT. I mean, there's really, I sort of look at it and say, well, there's really no reason that they should qualify for 1031 purposes, because partnership interests are specifically prohibited, but they were created, DSTs were created to allow people to buy into institutional real estate using 1031, and they work great, and they're very, very popular today. Something that's interesting to me is historically, they came into play around 2000, DSTs did. Before that, we had institutional TICs. DSTs historically were sort of a place to throw your money or excess funds at the end of the day when you bought what you really wanted. And that would be that thing, that fallback, where I've got clients today, they're sort of looking at that DST as the first course of action, which is sort of a different thing. But DST could be a single asset. Typically, it's multi-asset. Could be in one region, multiple regions, could be like any, I say food group, but it could be, if you like mini storage, buy that. You want apartments, buy that. You want retail, buy that. Hospitality, buy that. It's all there. But they're stabilized assets. Capital calls are strictly prohibited. It's non-recourse debt, and those things are always going to be there. You've got to be an accredited investor to buy into that stuff, but you can buy into that stuff with IRAs and 401k too, if you want the benefits of true real estate outside of REIT with institutional funding. An institutional TIC is typically that the tenancy in common structure is typically going to be used when we're looking at value add projects. So something that's not necessarily a stabilized asset, you're buying it with the expectation I'm going to get this cash flow, but I'm also going to get these other things because the sponsor is doing this and this and this and this and this to these investments, and ultimately I've got the cash flow and a pop at disposition over time. So both those things are out there. They're pretty popular these days, but they're a way to get into passive investments without having to deal with the work of, let's say, real estate. We look at current trends, and if you look down there about halfway down, you're going to see those DSTs, TICs, OZs are another thing that's out there. Opportunity zones, they were put in place 2017. We lost personal property exchanges at that point. I think we lost the personal property, got the OZ. The OZ was put in place in an effort to stimulate growth in areas, regions of the country that need stimulation, and it's a way to take your money out of the sale of business, out of the sale of a personal property situation, and convert it into real estate. I look at OZs sort of as a Roth IRA, where you're going to have limited tax deferral into the asset, but if you hold it to maturity, the gain on that asset is going to be totally tax-free. So it's a great situation if you're giving up things outside of real estate you want to get into real estate. People will also talk about it as a fallback to 1031. I want to caution you on this. Number one, I just think 1031 is a better vehicle if you go in real estate to real estate, because at this point in time, especially, we're looking at a development play. But if you want to use it as a fallback, you have to understand there's something called 1031-G6. 1031-G6 is the rule that dictates how we can release funds to a client in an exchange. And 1031-G6 basically says you can only receive the funds after you've purchased all property you have the right to buy. So we can not give you your funds at any time prior to midnight the 45th day. After the 45th day, after that ID period, we can give you funds after you've purchased everything you have the right to buy. So it's really important that when you get to that 45th day, you're either totally committed to completing the exchange or you ought to torpedo it. We've got a page, we're going to talk about this a little bit more later, but that OZ would only be a fallback if you, let's say, if you've ID'd something inside the 45 days and you rescind the identification, or after you've purchased everything you've got the right to buy, then you can take the excess fund, get it from the accommodator and go that way. But understand an OZ's got the same 180-day timeline to get invested that 1031 does. So make sure you're aware of that. Don't look at it necessarily as a fallback. Look at it as you could do a portion, or look at it if you're going to terminate the exchange, maybe that's where you want to go. But if you look at that first bullet, we talk about 1031-G6, we got a fair amount of transactions where people are doing partial exchanges. David, what do you mean by a partial exchange? A partial exchange just means that every dollar you spend over your basis in a property on a replacement represents tax deferred gain. So 1031 is not all or nothing. If your basis was $100,000, you sold a $500,000 property, and the perfect replacement property was $300,000, let's say, you'd defer the difference between the 100 basis and the $300,000 purchase. You'd have exposure on the difference between the $300,000 purchase and the $500,000 net of closing costs, let's say. And I want to caution you also, debt is not a closing cost, all right? Debt really has nothing to do with the exchange. What you need to do is satisfy what we call the napkin test. We'll talk about it a little bit later, but it simply says a cross or up in value and equity. But partial exchanges, we're doing a lot of them. If you said, David, I want to pull $10,000 out, go take a trip, or I want to go pay off something else, take some money out, whatever you're receiving that's not of like kind in the exchange, it could be a reduction value, could be cash, that's considered boot and taxable to you. And as I said, 1031 is not all or nothing. Every dollar you spend on replacement property, over your tax basis represents tax deferred gain. That third bullet, we've got a lot of people that are just sort of buying 45 days to figure it out. Do I want to complete the transaction or not? what's going to get me there? So really, we're sitting here, 9/14, 9/15. The tax people are working real hard. They're about to be done for this portion of the year, but you might not have had an opportunity to talk to your tax people. And this is what I'm going to tell you. I think your tax people, we're just one member of a successful team of investment people in your life. I think your tax people are the most important. All right, those people, you need to use them more often than April 14th each year. Talk to them when you contemplate a sale. Understand what your tax liability is going to be and when the exchange makes sense or ceases to make sense. Now, we're in a market that's zipping along right now. Is it going to be continuing that way? What do you think's going to happen in 6 months, a year? Would you like to have some patient money? Those with the gold make the rules, right? So the biggest problem with 1031 is you've got impatient money. You've got that 45-180 that's got to be addressed. You got to spend the money. You got to keep it moving. And you're still saying, well, gee, the market's still ripping along. Prices really haven't adjusted much, but I think in 6 months or a year, maybe they will. Well, there's an opportunity cost to the exchange. Maybe the exchange isn't the right thing to do. Maybe you want to pull some money out, or maybe you want to just sit on it right now, pile up the money, and be waiting for that opportunity. So 1031 isn't always the right choice. And your tax people are going to work with you to help you understand at what point the exchange ceases to make sense. Now, also understand that we've got, that gain on a disposition of a property, that's gain in one asset. Now, do you have, once again, get those tax people in play prior to year's end? You're going to look at, well, what do I have with Wall Street this year? What's happened in this space, that space? What's happened overall in my life? And having gain on the disposition of this property could be offset with losses somewhere else. Now, understand, if you're, let's say, Wall Street investments are all IRA 401k stuff, those things don't offset gains and losses. That's inside your plan. That's not you. When I talk to people about using IRA 401k funds in real estate or other things, I say, look, I know you think that money is you, but it's not. Think of it as Susie down the street. You wouldn't take her money. You wouldn't pay tax on her stuff. You wouldn't do these things with it. Look at that money as somebody else. And that way, I think it's a cleaner, easier way to look at your overall life consequences in a given year. But understand the gain on the property could be offset with stuff elsewhere. So really use those tax people to take care of things. Another trend, obviously, and this is why you're all on here today, reverse and improvement exchanges. Reverse exchanges, the market, you find that perfect property prior to the sale of your relinquished property. You can do that purchase, you can make it happen, and we can do the exchange using a reverse format, a reverse structure, okay? The other thing we're seeing is sort of a fundamental shift in the ownership of commercial real estate. We're seeing a situation where a lot of people are moving out of, let's say, high rent control areas because the mom and pops can no longer afford to deal with this stuff. The rent control has taken it out of their hands, and the tenants have the rights. And as we get older, we get probably less tolerant to dealing with all this stuff. So you're seeing mom and pop selling these properties and maybe shifting into these more passive investments, or maybe moving out of a region that's got high rent control issues like that and into another region of the country that's more friendly to them. Now, understand 1031 allows you to relinquish any real property held for investment, acquire any replacement real property with the intent to hold for investment. And we can do things in foreign lands also, but if we look at giving up a domestic property, we've got to go out and buy a replacement property that's domestic. So foreign for foreign, domestic for domestic. We can't go domestic to foreign or foreign to domestic. Those things are not of like kind. But as far as 1031 is concerned, you can go from California into New York, into Florida, into Texas, the Carolinas, wherever you want to go. It's all going to be fine. All right. DSTs, TICs, OZs, institutional investments. We've got major firms that provide REITs, DSTs, OZs, all these things are possible. And you just got to find those things. If we're looking at DSTs, some TICs, Some of the OZs, some of them are structured. You've got to understand, well, if you're a real estate broker, a DST is definitely sold through securities world. It's a securities product. So, you're as a real estate broker, you're not going to be selling those things. You're going to work with a broker that specializes in those things and make this happen. Some of the DST sponsors do provide opportunity zone offerings and UPREITs, which we'll talk about in a little while. Some of the institutional ticks are sold by through real estate channels, and some of them are sold through the securities world. We don't see as many ticks today as we do the DSTs in that space. We're also seeing combinations of 1031 and 121. Well, David, what do you mean by that? Well, there's lots of reasons today. If you look at Section 121, it was put in place in 1997. So it replaced the old Section 1034. 1034 was when you sold your home. You had 2 years to buy a new home of equal or greater value. If you're 55 or older, you had a one-time lifetime exclusion of $125,000 in gain. I would argue that 1034 is probably more attractive to a lot of people today than 121 is. 121 says if you've lived in a property for 2 out of the preceding 5 years, so it's not what the property is at time of disposition, it's whether you fit the 2 out of 5. An individual is entitled to $250,000 exclusion gain, and a married couple gets a $500,000 exclusion on gain. It's not a one-time thing. You can do it once every 2 years. Well, what happens if your home, you've got a home that maybe has $1 million in gain and you're single? Well, you get a $250,000 exclusion, you're going to have exposure on $750,000. You don't want to do that. Well, move out of it. Convert the property into an investment. 121 does not apply. I said it before. I'm going to say it again. 121 does not apply to what something is at time of disposition. It applies to anything that fits a 2 out of 5. So if you move out of your home, you've got just shy of 3 years to sell your home, still taking that universal exclusion. So we're doing lots of transactions where people are taking their home, converting it into an investment, selling it within 3 years. They take the exclusion, then they 1031 the overage. On the other hand, we buy a property via 1031. You gave up an investment property, you buy an investment property, so you hold it for a year or so, then you convert that property from investment to residence. There's no tax on that conversion. And then you can live there into perpetuity with no tax. Now, be careful if you sold that property, it was acquired via 1031. If you sold it within 5 years of acquisition, it'd be a fully taxable sale. After the 5 years, you're still not entitled to the 250 or 500. You're going to get prorations of that, prorations per the amount of gain attributable to qualified versus non-qualified use periods from April of 2009. That's called the Housing Assistance Tax Act of 2008. So once again, the Housing Assistance Tax Act is sort of going to be that guiding light with respect to tax treatment on a property acquired via 1031 and later converted into a primary residence and later sold. But those combinations are happening. Finally, we've got combinations where people are saying, gee, I've got this property, I've got a 1031 that we're completing into something, but I want to buy something more, or I want to diversify my Wall Street stuff, my IRA 401k stuff. I'd like to take that and go in and buy it in combination with 1031. And that is possible. Now, it's going to require a tenancy in common structure. So typically, if you wanted to combine personal money and planned money in a common investment, you'd have a choice. You could go tenancy in common or as common members of a limited liability company. There's benefits and pitfalls to either structure. But if we're going to combine 1031 money and IRA 401k funds in a common purchase, 1031 prohibits, once again, the use of a partnership interest. So we're going to buy tenancy in common instead of as common members of a limited liability company if we're doing that. So your next question is, David, you just talked about converting a residence into investment. You talked about converting investment into residence. Well, I've read, and if you've been on our presentations before, you've heard me say, my father used to say, anytime you read something about what you know something about, you know how wrong it is. And I see out there all the time. I think one of our videos on YouTube that has the highest view count is, the 5-year hold in 1031. Well, what is that? And that's really, it comes back down to what I just talked about with the acquisition of a property via 1031, the conversion and later sale. That's the only 5-year hold there. Once in a while, people say, well, David, the code says 2 years. It says if I exchange a property, I've got to hold it for 2 years. It does, but only in the context of a related party transaction, and only if there was some effort to avoid taxation. And what I mean by that is, if you read the fine print, even in a related party transaction, it says 2 years, or if there was no effort to avoid taxation, that would not apply. So it's not even an absolute in a related party transaction. There's a 2-year hold. Now you ask, well, David, how long would I like to see you hold something? And I'm going to tell you a year based upon 2 factors. One, the break between short and long-term tax rates on assets held for investment falls at 1 year. And 2, it's been proposed a couple times. So I think 1 year is a good number based upon those 2 things. If it's less than that, this page talks about the recent court case. This is a situation where property was acquired via 1031, converted from investment to residence after 4 months. The people got audited, they got taken to court, and they prevailed in court after a 4-month hold. Yeah, I don't think 4 months is long enough, but during COVID, we had a number of people that maybe bought a property, and all of a sudden the governor in a given state says, hey, tenant doesn't have to pay, they can't afford to keep the property, and so maybe they only held it for a couple of months. Or maybe you had a situation where you bought a property, unsolicited offer comes in, it's too good to pass up. Could you take that offer after a month or 2? Yeah, you could. You just want to make sure your tax people are comfortable with it. Now, you have that same thing happen again. Now you've got a problem there because you're establishing a pattern, you got issues. There's also a court case where a property was acquired via 1031, held for 5 years and sold, and the exchange was disallowed. Well, why would a property held for 5 years be disallowed in a 1031? Well, the property was put on the market immediately upon acquisition, just took 5 years to sell. So the property was never held for investment. So when we're looking at seasoning, who do you need to talk to? You need to talk to your tax people, plan this stuff out, make sure everybody's on the same page and everyone's comfortable, because now we've got another, what, $87,000 or $87,000, 87,000 auditors that have been hired. And that's a lot of eyeballs looking at stuff. So we want to make sure that you're comfortable, you're planning ahead. And my advice is talk to your tax people. Don't do things they don't want you to do, because if you're ever questioned in an audit, you want them to say, yeah, this is why we did what we did and how we did it, and we're comfortable with that. That's why they're so important in your life today. So holding periods, there's no stated required hold, period. 4 basics, then we're going to get into the reverse stuff. So any exchange is going to require these things. 1, something's going to be given away, something's given back. Now, basically using, if you look at an exchange in the most basic context, you give something away, you're giving something back. All right, if you've got a situation where, let's say I've got something, you've got something, both those assets are of equal value and equity, and you want what I have and I want what you have, and we just swap properties, you don't need us. That's just a swap. A swap agreement will take place. If you wrote up a purchase sale agreement in that transaction, if you look at a purchase sale agreement, it doesn't say total cash paid, it's total consideration. Maybe I've got a small property, I want to buy your bigger property. I could use my property as partial consideration for the purchase. I could do that swap. Now you would have to have an exchange structured if you wanted to defer everything in that situation. But once again, in a true swap situation, you don't have to have an accommodator. Most exchanges in today's world are done using an accommodator. All right, and the benefit of using an accommodator is you just put on the market what you don't want, negotiate the sale, you find what you do want, negotiate the purchase, and basically you're paying us a fee to structure the exchange. So in a delayed context, you're going to give us something, we sell it, you tell us what to buy, we buy it, and we give it to you. You've got 45 days from settlement to ID, 180 days total time to get it done. Both 45-188 start at settlement. A reverse exchange in today's world is really a simultaneous exchange. It either happens at the date of acquisition or the date of disposition, but you cannot legally own both the new and old property at the same time. There's still an exchange. You're giving us something, we're going to give you something back. And we're going to get into that much deeper in a few minutes. 2, the items relinquished and received must be of like kind, nature rather than form. Any real property held for investments, like kind with any real property acquired with the intent to hold for investment. 3, you need to go across or up in value and equity for total deferral. Now, what happens in recessionary times? typically we've got a reduction in the loan to value that's available, and we're probably going to have a reduction in equity in an asset. So it's not uncommon for people to have to add money to make a purchase happen. Or maybe you don't want to have any debt on the replacement property. So you can, debt can go away two ways, one by going down in value, the other by adding cash. Going down in value triggers tax. Adding cash to a transaction is always fine. So I'm going to say this, if you are in a situation where you're selling a $500,000 property, it's got 250,000 in debt on it, and you want to go out and buy a replacement property of $500,000 or more with no debt, you don't have to pay that relinquished property off pre-disposition. You're just going to show up at the acquisition of the replacement property with the money, with that additional 250. The debt has gone away. You still met the value requirement, and you have no tax exposure in that situation. Once again, the other way debt goes away is by going down in value, which triggers tax because you went down in value. Finally, we've got to have continuity of vesting, which anybody that's done an exchange is going to tell you the hardest thing about any exchange is time. You're all on this call today because you're tired of dealing with the time. You want to be able to buy something today before selling what you don't want, or you don't want to have to worry about those things. And that time issue gets to be very problematic very quickly. Vesting is the second biggest problem we've got in the exchange world, because those who have the gold make the rules, and it's, depending on what state even, it can be a complication that comes up. I'm talking to you from Portland, Oregon. Okay, so Oregon's not a community property state. So it's very common for one of my clients, maybe spouses, they buy a property, then they buy another property, then they buy another property, and then their legal counsel says, you know what? All of these properties are giving you some liability that I don't think you should be comfortable with. So let's create a limited liability company and just shove the properties into it. Okay, so now you sell that property and you own that relinquished property in a limited liability company with two spouses in it, right? So now you go to buy the replacement property, and if it's 4 units or less, it's a residential loan, it's going to be more expensive money. You're going to need somebody, a portfolio lender probably, to make that loan. And so now you're saying, David, we don't want to buy that replacement property in the limited liability company. Well, if you lived in, let's say, California or Washington, you can give us a property held in LLC and go buy personally. Once again, we're talking multi-member LLC with spouses as the members. In Oregon, not community property state, you can't do it. So that's how easy vesting gets to be a problem. Remember earlier, I talked about combining IRA 401k funds with a 1031. That requires tenancy in common because we have to meet that continuity of vesting requirement, and partnership interests are specifically prohibited. So, that's how vesting gets to be such a problem. Let's say 5 of us own a property. What do you think the odds 5 of us are going to want that property in 5 years? Probably not that good. So somebody wants to go out, or we want to sell the property and we all don't want to go forward together, we're going to have to drop that entity from that limited liability company into a tenancy in common. That will allow us to go different directions. Then we're back to that last page on seasoning and when that needs to happen. And I got to be honest with you, people have these conversations with me maybe a year pre-disposition. I'll be sitting in a conference room with my client and their tax counsel and maybe their legal counsel and a group of investors, and everybody leaves that room that day agreeing that we're going to drop from that limited liability company into a tenancy in common. And then a year later, I get a copy of a title report because now they've got a sale pending, and I look at the deed and that didn't happen. I go, hey guys, why didn't this happen? It's, well, it was too cumbersome, time consuming, and we had a loan on it that might have been accelerated, blah, 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 all those things. So really, anytime we're breaking ownership from a partnership issue into individual tenancy in common to allow people to get where they want to go, we're going to have a seasoning period. And once again, you're going to work with your tax people to decide when you should do that and how to make it happen. And I'll just put this out there too. Some states chase these things more than others. And once again, we've got, on the federal side, we've got the IRS with more people. But if you're in a state, like Texas or Florida, someplace where there's no state tax, you don't have the state chasing you in addition to the federal government chasing you, or potentially making a problem with a drop at close from a limited liability company into a tenancy in common structure. So the timelines in an exchange, and actually one thing, if we look at the like kind requirement, once again, it's nature rather than form. So you can go from a rental house into apartment building into office industrial. It doesn't really matter. As I said, you could buy a place at the beach to retire into. All those things are going to be fine. You know, if you're looking at leasehold interests, a leasehold interest in real property can qualify too. It's just got to be a leasehold interest of 30 years or longer, or with extensions to 30 years. So certain leasehold interest also qualifies like kind for any of these other things. All right. So the timelines, as I said earlier, we've got 45 days from settlement to identify what you'd like to acquire, 180 days to receive one or more of those properties. Once again, we're in September. So now we're starting to look at it's 180 days of the due date of the tax return. So if you enter into an exchange anytime from now on, understand you need to complete the exchange prior to filing your tax return. When we start getting into late October, November, December, if you're bumping into, if your 180-day timeline's bumping into that April 15th and you haven't completed the acquisition, you're going to want to file an extension on that tax return so you complete the transaction prior to filing the return. Really important, once again, 180 days or the due date of the tax return. Next question, are there any extensions granted? Well, not short of a presidentially declared national disaster. So if you've got a property or your accommodators in an area, a region that was impacted by a presidentially declared national disaster, you may be entitled to an extension. So certain regions of the country, we have extensions a lot more often than others. So along the West Coast, I think the only extensions I can remember in recent years, we had one for COVID, and we've had a few for fires in different regions too. So make sure that you're working with your tax people and your accommodator to understand whether you've got any potential extension if something that you believe has impacted your ability to get the deal done does happen. Identification, this is one of those things people get confused all the time on. They say, well, gee, the code says you can only ID up to 3 properties. No, that's one of 3 different identification rules. Identification just means you're giving what the government would deem an unambiguous description of the property or properties you intend to buy. That could be a common address, including city, state, and zip. If you're going to buy a fractional ownership in something, make sure you're identifying the portion that you intend to buy. And you've got these 3 rules, the 3 property rule, the 200% rule, and 95% rule. When you're looking at the 200% rule, it says you can ID any number of properties, total value of which can't exceed 200% of the relinquished property's value. Well, what's a property worth? Is it worth what it's listed for? Does a property even have to be listed to be identified? And the answer is no, it doesn't. So when you're looking at identifying things that are not currently on the market, you sort of have to look at what you're willing to pay for it, highest best use, and that's the number you're going to go with. And that same thing's going to apply to that rule C, the 95% rule, which says you can ID any number of properties, but you have to close 95% of the aggregate value of all properties ID. So once again, C is you can ID any number of properties. They can be of any value, but you got to close 95% of the aggregate value of all properties ID, which means you're buying literally everything you've identified. 1031 G6. When you can get your money, once again, at no time prior to midnight the 45th day, after the 45th day, only after you've purchased everything you have the right to buy. So we look at the last slide on identification. Let's say you use a 3 property rule and you're IDing 3 properties with the intent to buy one of them. Well, in our ID form, or if you're working with somebody else, you could write, okay, I'm identifying these 3 properties, but I only have the right to buy one of those. So you're identifying, you can ID 3 with the intent to buy 3, or you can ID 3 with the intent to buy 1. If you're doing 3 with the intent to buy 1 and you've got residual proceeds, you put that 1 in there if you're on our form, or if you're using somebody else, just say, hey, I'm IDing 3, I only have the right to buy 1. After you've purchased that 1, then you would be entitled to the residual proceeds as long as we're outside the 45 days. So this is really important in today's world because this is something that comes up a lot. People are buying or selling something, they get in the exchange, they don't know if they're going to complete it, they haven't found what they wanted, now they want the money. And this thing is it's not our company policy, it's federal law with respect to this. It's the code. Any exchange company that gives you money outside 1031 G6 their policies and procedures are flawed. Any exchange done using that policy is not valid. So it's critical that the exchange company follows these laws because it impacts every exchange. All right. Warehousing transactions. Now we get to the fun stuff. Reverses and improvement exchanges. So warehouse transactions are a situation where anytime the accommodator, facilitator, intermediary takes ownership of a property for a period of time. A warehouse transaction would be a situation where maybe you're using a property as partial consideration for a property. Maybe let's say I'm selling a property, the buyer wants to use their property in cash or their property and a loan to buy my property. Well, I don't want that property, let's say, as a seller. Well, if I were to take the property and sell it, and I'm wanting to do an exchange too, I got a problem. So what happens is the property gets transferred to the accommodator and then is sold and converted to something that can be used, all right, in the exchange. So that could be a form of warehousing. Otherwise, typically we're using warehouse transactions when reverse exchanges, when RevProc 2000-37 was put in place in 2000, prior to 2000, and as I said earlier, we started the firm in 91, so we had 9 years where we were able to do reverse exchanges in the warehouse structure that we're talking about today, or in a true reverse exchange format. And that's gone. So now we use warehousing. As I said at the top, you can't own the new property and old property simultaneously. So a warehouse relinquished property means that we're going to take ownership of the relinquished property. So you're going to show up the purchase replacement, buy it. We are immediately transferred the relinquished property. We're entitled to it until it sells. A warehouse replacement reverse exchange means we're taking ownership of the replacement property. You're going to maintain ownership of the relinquished until it sells. What about Bartell? There was a court case a few years ago now. It's been a number of years now, and people looked at it, and that was one of the rulings with a true reverse exchange. Once again, it's something that's not really, or actually Bartell, I'm sorry, was timelines in excess of the 180. And it could be done, but you're looking at a situation where if we're working within RevProc 2000-37, we don't have to worry about benefits and burdens of ownership. If we're working outside 2000-37, then we have to actually have skin in the game. So once again, inside 2000-37 means that we can sort of act as an agent. You're going to have the benefits and burdens of ownership, even though we have title of something. If we're working outside it, we have to put money into it. We have to have a potential upside, and we have to be on the hook for any potential downside. So it's very, very rare that you'd ever see something working outside 2000-37. An improvement exchange is another form of warehouse transaction. And it's really the same structure as a warehouse replacement reverse exchange. The only difference is we're working on the property during the time we own it. So we do a fair number of reverse improvement exchanges too, where we're needing to create more value or create a bigger property to satisfy the exchange. And just during the time we're on a title, we're doing the work. A blended exchange could be a combination of a reverse exchange and a delayed exchange. That can happen if we have to do a warehouse, let's say a warehouse replacement reverse, but we need to go buy something else. Maybe you're selling multiple properties, but we can combine a reverse exchange and a delayed exchange if it's desired, and we call that a blended transaction. So when we look at the reverses, first thing we're going to ask is that, or you're going to ask is, do we loan money? And we don't loan any money. So you have to, as the taxpayer, have the financial ability to buy a property today to replace something yet to be sold. If you don't have the ability to make that deal happen, we're not going to do that transaction. So number one, you've got to have the financial ability to buy the property today without having the proceeds from that future sale. Okay. When we're looking at this thing, the next question is going to be, do you have the money to buy the thing outright? If so, it's a nice, clean, easy transaction. If you're going to require lending to make that purchase happen, then it's going to get more complicated because that's going to change potentially the structure of the reverse. A warehouse replacement reverse exchange means that we're going to take title of the replacement property. Think about that for a second. So that loan would look like this. The lender would make a loan to the limited liability company that we're the sole member of. In this context, that limited liability company in the exchange world is called an EAT, an exchange accommodation title holder. So basically, the bank's going to make a loan to that EAT, that LLC that we're the member of. You're securing that loan. The loan is still secured by that property, but you're a guarantor on it. So you're going to go out and apply for it. Ultimately, it's going to be yours. In a perfect world, when your property sells in the future, we do an assignment of membership interest to that LLC from us to you, completing that transaction. So once again, to do a warehouse replacement reverse exchange, if lending is required, we need a bank. Typically, it's going to be a portfolio lender, a regional bank, or some hard money person that's going to allow us to make that purchase. That same lender, that same lending requirement is required in an improvement exchange, because once again, that property's purchase being financed, it's being loaned, the money's being loaned to the EAT that takes ownership. You're securing the financing, the loan's still secured by the property, guaranteed by you, but it's to the entity we're the member of. So, if you walk into a big bank or just somebody that's going to sell the loan, they don't have a box to check that's going to make that thing happen. So that lending is going to dictate what form of transaction we do. So if we're doing a warehouse replacement, it's harder to get that loan than a warehouse relinquished. A warehouse relinquished means at the date of acquisition, ownership goes straight to you, the lender's not impacted, and that relinquished property gets transferred to us. So if we've got, depending on the structure, warehouse replacement or warehouse relinquished, if we're having to do a warehouse relinquished reverse exchange and you've got less money to put down than what you expect to net from that future sale, you're either going to have tax exposure on that difference, or you would, from the date of relinquishment, you could go buy additional property to offset using the blended structure. We still have 45 and 180 days to get this thing done. We cannot have ownership of a property for more than 180 days. So if we look at a reverse exchange, it's going to sound sort of funny. I mean, obviously the 3 property rule works pretty well. We typically know what people are selling, but sometimes we don't. But you're still looking at the 3 property 200%, 95% rules, which 295% rules, those things look sort of squirrely when you start looking at how you're identifying what you're relinquishing. So typically you're going to have an asset or maybe a couple assets you're looking to relinquish, and you're going to identify those within 45 days of acquisition. You've still got that total 180 days to sell what you don't want. So if we look at a warehouse replacement reverse exchange, once again, in that situation, I like these the best. It's easier for us to do it. It does require you to make a cash purchase, or it does require you to have a lender that's going to allow us to take ownership of that property. So a warehouse replacement reverse exchange, once again, means that we're going to create that limited liability company. In the exchange world, it's an EAT, exchange accommodation title holder. So it's a single member LLC with equity advantage as the member. You're going to show up to purchase that property with that money required to buy that property. That down payment or that purchase, whatever you walk into escrow with at that point in time, is treated as a loan from you to our EAT. Okay, so you've loaned us money, we buy the property, we stay entitled to that property until you sell your relinquished property. When you relinquish that property, the proceeds from that sale come to us as they would in a normal delayed exchange. We are then going to take those proceeds and repay the debt we have to you. If we have funds beyond what you loaned us, we then have the ability to buy additional property, or you can take the balance of those proceeds, pay down the debt on the replacement property, or maybe build on that replacement property. And then we would then at that point convey ownership of the replacement property back to you, completing the exchange. The conveyance of the replacement property could happen 2 different ways. It could happen with a deed from our EAT to you, completing the exchange, or it can happen with an assignment of membership interest from us to you if it's a, if it's a individual or a disregarded person that's doing the exchange. So spouses in a community property state in an LLC, we can transfer that way, or it would be a single member. But I really like the assignment of membership interest. Something to think about that people don't think about with reverse exchanges if we do the warehouse replacement is when you buy a property, who's the title policy pay? or cover, I mean. The title policy covers the buyer. So we want to make sure if we're not going to use the assignment of membership interest, or if there's some prohibition of doing an assignment of membership interest with the title policy, we want to make sure the title policy has an additional insured, you, or it's going to allow the assignment without having it go away because you paid good money for that. Somebody paid good money for the title policy. We want to make sure it's in force. The other reason I like the assignment of membership interest is if there's a loan on the property, the loan documents don't have to be changed. If we've got transfer taxes, it could be applied. Some states, some areas, you've got transfer taxes, you got to read the fine print with respect to assignments of membership interest, whether those trigger any transfer taxes, but that could be something that is helpful to get away from too with the assignment of membership interest, where if we're deeding from our entity to complete it to you directly, then that's going to require some different changes. So once again, we want to make sure a title policy is going to cover you. I want to see what other costs are going to be there. Somebody's going to have to draw a deed, transferring the thing, where the assignment, we're just amending the operating agreement, taking care of the LLC that way. So if we're doing a warehouse replacement reverse exchange, we're going to want to know, can we do the assignment membership interest? If you want to own this thing as an LLC, what do you want the name to be? And what state of registration do you want the LLC to be registered in? So there's California, for example, you got roughly $1,000 a year for an LLC. It's not very attractive. Washington State's 60, other states might be as low as 40. I think Colorado's 40. I mean, so you really sort of look at, we typically do the LLCs either in, state of residence or state of investment, depending on what's going on. Texas, we might have a foreign investor rules that might make it very beneficial to have a Texas entity. So you just talk with your tax and legal people, figure out what you want to do with that. But, we can structure that however we want to do it. The warehouse relinquished transaction means that when we go buy that property, you're still going to show up the purchase with the money required to buy the property. We're going to buy it, but we're immediately going to transfer it directly to you. So it's just like phase two. Phase two is what you're buying in a delayed exchange. The lender's not impacted in this transaction. So you're going to show up the purchase with the money required to buy it. We're going to buy it. And then ownership is direct deeded from the seller to you. At the same time, that transfer on the purchase is happening. You deed us the property that's to go away, property or properties, and then we're entitled to those property until they go away. When they sell, the proceeds from those sales are going to come into us. We're going to pay back the debt we've got to you to the extent we can. Any excess funds are going to be either taxable to you, or you're going to then go out and acquire additional property if you've got time to get that done. So we've got those timelines we've still got to work with. But I typically like the warehouse replacement better because once again we can pay down debt, we can do improvements, we can do a variety of things with that format, where when we take ownership of the relinquished property, we really have a hard 180 to get these things done. And anyway, but the warehouse relinquished takes care of any lending requirements because the lender's just straight up financing a purchase as they normally would, which makes them happy. Okay. So these requirements, at the time property is transferred to the EAT, the taxpayer's intent that the property held by the EAT represents either the replacement or relinquished property. We need to know that. No later than 5 business days after transfer of the property to the EAT, there must be a QEAA agreement, qualified exchange accommodation agreement. No later than 45 days of the transfer, we got ID, what's going away. And then, we've got the total 180-day timelines to get these things done. These are, the 4 basic cornerstones of a reverse exchange. By the way, obviously I'm speaking quickly. We're getting through the stuff, but if you've got questions, we'll be addressing those off this afterwards. So if you've got questions, don't worry, we'll get to you on those. We'll just be replying via email to your questions. I apologize about that. Blended transactions, as I said, we can acquire property. So think about a warehouse replacement reverse. You've loaned us money to go buy a property. We've got 180 from the date of acquisition for you to sell what you don't want. At that point, we're going to transfer the replacement property to you, and you'd have 180 days from the date of relinquishment to go buy additional property. So that's a reverse, a blended transaction. You could have multiple properties you're relinquishing, and maybe you sell 2 or 3 before the purchase happens, and then you've got the residual 2 or 3 that are coming in via reverse. So we can do it if we're looking at it from acquisition and buying additional property, or we can look at it from the context of blended transaction. Could be a situation where we're relinquishing multiple properties, some of which have been closed before the acquisition, some of them will close after that acquisition. Either one of those is a blended transaction, and we can help you out with those things. Partnership transactions, as I said, partnerships are specifically prohibited from 1031 treatment. So we're always having to break from that limited liability company. And I'll caution you, for some reason, we sort of go in waves on stuff, but owning property in S Corps and C Corps, it's not pretty, okay? Because that entity can do an exchange, but you can't get in or out of that entity without going mark to market. And I heard, we're looking at some stuff yesterday talking about, because I see people, websites, companies that are still saying, oh, 1031 under threat, blah blah blah. It's always under threat, but really right now, to be honest with you, we're pretty safe at the moment. Nobody's threatening us with anything. The last proposals were capping deferral at $500,000 per person per year. There was also one of my biggest concerns with Biden's tax reform was going mark to market on distributions from LLCs. So typically in the real estate world, we're looking at ownership. If it's joint ownership, it's going to be tenancy in common or via multi-member LLCs. And in those situations, we're going to have to break the entities before we go different directions. But I want to stress once again, and a break predisposition would be a drop and swap. A post acquisition would be a swap and drop. Each of those require seasoning periods, and if you got questions on this, we'll talk about these further in a more, in let's say, a presentation titled "The Fun Stuff" or something like that. Complicated transactions, anyway. So the deal with any of those, it's always a combination of vesting issues and seasoning. And once again, the partnership can do an exchange, but we can't take the members in and out, and we've got to be careful once again in a non-community property state. If those members are even spouses, it can be problematic. But just going with an S or a C Corp, just taking an asset out of those entities goes mark to market, triggers tax. And once again, Biden's last tax proposal had proposed doing the same thing with limited liability companies, which would have been devastating, and that's safe at this point in time. Joint ownership with an IRA could be either as common members of a limited liability company. It could be tenancy in common. Again, tenancy in common is required if we're doing a 1031 exchange. Notes in an exchange, you can sell and carry a note and trustee or land sale contract. I prefer greatly the note and trustee transaction with 1031s. Think of that note as just another non-alike kind item that's being received. It typically represents equity. So the exchange, once again, via the napkin test, requires you carry all value and equity forward for total deferral. So what happens if you've got a seller carryback note trust deed on a transaction? The note's going to come to us, the cash is going to come to us. We can discount sell the note. We could, you could buy the note from us. You're going, gee, why would I buy my own note? Really, what you're doing is substituting cash for the note. Now you got the benefit of the note's payments, and you've got the cash to, complete the transaction totally deferred. Maybe it's a short-term note. Maybe the property selling is not financeable, needs some work. You wait till the note balloons and we complete the acquisition, or maybe you're doing a partial exchange. So don't let somebody tell you you can't do an exchange with a seller carryback. It's just more complicated. We've got a variety of tools to make that transaction happen. Notes in a reverse exchange, on the other hand, work just great, because think about how we do that reverse exchange. On an acquisition, you're going to show up with the money required to buy that property. We sign a note between Equity Advantage and you for that down payment. And when your proceeds from the future come in, we use those proceeds to repay that debt. Well, why can't we use a note to repay the note? So if you sell and carry paper, the paper comes to us, we can use the paper to make you whole just as easily as we can use cash to make you whole. So notes in a reverse exchange, buying on a note trust deed is never a problem. It's when you're selling on a note trust deed or a contract, that's where the problems exist. But using a note trust deed on the sale of your relinquished property in a reverse exchange is not a problem at all. It works great. A few examples were done. So in this situation, we had a guy come in. And it's just basic selling a single family rental, going out and wants to buy a duplex. And in this situation, he didn't have all the money that was necessary to make the purchase, so he had some money. And what we did in this situation is if you're not aware of it, let's say you got an IRA, you could take your money once a year for up to 60 days without a tax consequence. You just got to get the money back into that plan within 60 days. So this guy came in with the money that he had. He took money via the 60-day rollover on an IRA, combined that money, allowed us to make the purchase. And then when his property sold, the proceeds came in, we repaid the debt, and part of that debt repayment we had to them was represented by the 60-day rollover money of the IRA, and he got the money back into that retirement account. Now, I want to stress, you only have 60 days to get this done. So things got to move fast, and you got to be making things happen. And I guess one thing I didn't say about reverses at the top that I'm going to say right now, just because it's there doesn't mean you should use it. All right, so use the reverse as a fallback. Don't use it as your first course of action. I'm always going to tell you the best thing you can do for yourself is time a transaction. Ask for whatever time you feel you need to get the deal done. And if we get up against that timeline and your property hasn't sold, then we can do the reverse. I'm going to go back and also say that, if you're looking at a basic delayed exchange, your base setup fee might be something between $750 and $1,250 for a delayed exchange. If we're doing a reverse exchange, the base setup is over $5,500. So I would say if you're looking at smaller transactions, instead of paying me all that additional money to do the reverse exchange, just see if you can buy the time to make the deal fit. So if you've got a seller that says, hey, no, this is the date I got to get it done, and you're 2 weeks apart on the sale of your property, so you can pay them a few $1,000s to wait instead of having to go through all the hoops with the reverse exchange. All right. So that 60-day rollover in this situation was a source of funds to get the deal done. Okay, and in this this transaction, this really doesn't have anything to do with a reverse exchange. So this just talks about seasoning, converting properties, and this is one of those trends of today. This is an example that I always give. This was a deal we did. This was during the last crash. Sold a $3 million apartment complex. What they wanted to buy was $1 million investment property in the desert. Ultimately, they were going to convert it from investment into residence. And if you look at this situation, they went from a $3 million property to $1 million property. They had $2 million in boot, which that's a lot of money. But their basis on the relinquished property was $250,000. So they still deferred the gain on the difference between the $250,000 and the $1 million, which deferred gain on $750,000, saving $250,000 in tax. So that made sense. Buy what you want to buy. The reason beware of the Housing Assistance Tax Act is in bold at the bottom is for all the reasons we talked about earlier, with conversion of an asset from investment to residence in a future sale. Be careful with a 5-year hold. Be careful with the Housing Assistance Tax Act, because those things are there to bite you. It's not all or nothing. So in this situation, we just had a transaction going from bigger to smaller, and we have a situation where this is a warehouse transaction. There was a property being used for acquisition. The property came to us. We sat on it until it sold. As soon as it sold, we had all the proceeds that were necessary to make our client whole, satisfying the napkin test, and then we completed the transaction. So once again, we had a cash come in on the disposition, and then we had a property come in on disposition. We held that property for our client until it was sold. When it was sold, we had the balance of the money that was then used along with the balance of the proceeds to complete the transaction, totally tax deferred. Another transaction where we're just looking at acquisition of a property via reverse exchange. The people just really, with the rent control stuff, they really had a problem where things weren't going to be working, and things got pushed out. So the warehouse replacement reverse exchange was used, and we ended up completing the transaction with acquisition of additional property after acquisition. So it ends up a blended transaction. But we can do all these things with planning with time. Okay. And you know, in this situation, we really had a more, you know, another blended transaction came up, and it's just more echo of the last page. And in the interest of time, I'm going to get by it. I've got one more example I want to get to. I'm going to set you free today. If you got questions on either one of these last two slides, just let me know. So the last example, I'm steering you in a different direction, just once again, giving you an idea of what's going on with different transactions today. If you've been on our classes in the past, you've seen me talk about this. This is something called a rollover business startup, the acronym's ROBS. And in this situation, it didn't have anything to do with an exchange. It's a teaser to get you to come listen to our presentation next week on IRAs and 401k plans and real estate. But in this situation, people came to us, a husband and wife retired. They want to take their retirement accounts, go out and buy a mobile home RV park. And when they first talked to us about it, we thought we were going to use a checkbook IRA, which for the sake of time just means multi-member limited liability company with his and her IRAs as its member, or legally speaking, the trust company representing his IRA and the trust company representing her IRA. That was the membership of the LLC. You know, well, not LLC. In this situation, a 401k plan, we moved the money into the 401k plan, created a C corporation. And in a checkbook IRA, it's the IRAs, and a multi-member LLC is a checkbook IRA. We can't use a checkbook IRA in this situation because of prohibited transaction situations. So normally we'd use a checkbook IRA to go buy a mobile home or RV park, but we shifted gears from that checkbook IRA situation into a rollover business startup. So instead of using an IRAs and a limited liability company, we use 401k plan and a C corp, and that allowed these people to make the investment they wanted. It allowed them to be the on-site managers of the property and to live there. So they got an investment, they got a job and a place to live, all with this rollover business startup, which is a pretty interesting thing. Keep in mind, when we're sourcing a retirement account, a self-directed retirement account, any IRA can be self-directed. 401k plans, if it's a current employer plan and you're under 59 and a half, that money's off, you know, out of reach. So when we have people change jobs, you have an opportunity to roll those funds from a 401k into a self-directed IRA if you want at that point. So changing jobs would allow you to do that. During the last crash, I actually had somebody with a corporate plan that did not allow the person to go to cash. And this person was so concerned about what was going to happen in 07, 08 that he literally quit his job to get access to the money. And in his position, he just said, look, I can't afford to work another decade to get back to where I was, where I am. And so he ended up, you know, quitting his job, rolling the 401k funds into an IRA. We did that for him, and he went out and did some other stuff with that money. But you understand when you have access to it. This slide just exhibits what's possible, you know, at the end of the day. So in games, you can swap till you drop. That was something that, once again, Biden's tax proposal would have eliminated, and it's still there. So use it while it's there. Swap till you drop means that you can exchange. When you pass away, your heirs are going to get a stepped up basis to current market value. They could sell, pay no tax. So that's swap till you drop. Exchange into a retirement house. So that talks about acquiring a property, converting it into your residence, then selling it at a later date. Understand the 5-year hold, understand what the Housing Assistance Tax Act says, but you can do those things. Exchange until it makes tax sense. What do I mean by that? Talk to your tax people, understand what's possible there, get their idea before a year's in what's going on. And you know, maybe this is not the year you do the exchange. Maybe you can offset the gains with losses. That's what I mean. So, you know, keep that in mind. Exchange into a passive investment, DSTs, institutional ticks, those things. An UPREIT is 721 down below there. UPREITs are, I look at them as the ultimate installment sale. So you've got installment sales. Be cautious about a regular installment sale. I was speaking at a conference a few months ago, and somebody was on stage before me. They were talking all these nothing down transactions being so great. Well, the person was a real estate broker, and I was thinking to myself as I'm listening, I'm thinking, well, better be you know, cognizant of who you're legally bound to represent, because if you sell a property doing a seller carryback, straight installment sale, you're going to be taxed on debt relief and depreciation recapture in the year of disposition, whether you receive a payment or not. You've also got to have enough money to cover, escrow fees, brokers' commissions, anything else that's happening. You're doing exchange, I'd like to get paid too. So you better make sure that you're getting enough on an installment sale to cover all the closing costs and cover any potential tax liability on debt relief or depreciation recapture if you're doing a straight up installment sale. Structured sale is just an institutional installment sale. The obligation to pay gets shifted to a third-party assignment company. Typically, it's a whole life company. An UPREIT or 721 UPREIT is, I think, the ultimate installment sale. You're exchanging into a Delaware statutory trust investment typically, and then after a period of time, that property gets absorbed by the REIT, and now you've got shares of the REIT, and you didn't have to pay the tax and debt relief depreciation recapture, and then you're going to pay the tax as those shares of the REIT are sold, literally as you choose to do them. So it could be all at one time or over the next decade, whatever you want to do with it. So I really think UPREITs are very attractive. Now, a word of caution on them, you do end up owning shares of a REIT. So those shares could go up in value, they could go down in value. They are a dead end also. After you've gotten into the REIT, there's no way out without tax. But like I said, if you're looking for the perfect installment sale, that could be your tool. Opportunity zones are out there. If you're interested in opportunity zones, please take a look at our YouTube channel. We've got lots of information on opportunity zones there. You can learn a lot. And then finally, gifting. Okay, so we've got lots of clients who buy property. They've got some kids. They buy a property for each kid, and then they end up transferring things. Now, many of you have seen this happen. Somebody will just deed a property to their kid. What'd you do? You just gave them all the equity in the property. So you got to be careful with the gift tax rules. Today, we're still looking at 15 per person per year. So if you give your kid, $100,000 equity in a property, you just gave them $100,000, you could have a huge tax consequence there. So a lot of times with gifting, you can apply discounting. So if you transfer minority interest in a property, you can discount that portion by up to 40%. So once again, this is a great reason to talk to your tax people before you do any of this stuff, not afterwards. Give them the opportunity to help you. So we've got the last page. Thank you so much for joining us today. IRAadvantage.com handles retirement accounts. If you are interested in doing something with your retirement account, you can take a look there. If you're looking for a place to put a property, if you're a broker, if you're looking for property, we've got Post 1031. That's a property listing site for people working through transactions, and 1031exchange.com's Equity Advantage. I want to thank you all so much for putting up with my technical difficulties at the beginning today. If you once again need credit hours, reach out to Seymour at 1031exchange.com and she'll get you that information. This video will be up on YouTube for you to watch later. The only dumb question is the one that's not asked. So if you've got questions, please don't hesitate to reach out. And thank you so much for joining us today. Once again, David Moore, Equity Advantage, 1031exchange.com. Thank you and have a great day. Take care. Bye-bye.